Hello and welcome to financialexpress.com to another episode of CXO Connect. And this time, I have with me Mr. Prateek Agrawal, who's the MD and CEO of Motilal Oswal Asset Management Company Limited. Why are we talking asset management? Well, since you've seen the equity markets growing in the last few years and the frenzy that there is, especially with retail investors, into jumping into the equity markets, is that a good thing? Or, as they say in Prateek's language, mutual fund sahi hai. Let's ask him. So, you run Motilal Oswal AMC, and obviously the markets have been on a bull run of sorts in the last 5 years. If you look at the 5-year growth, it's almost 100%. But if you look at this year, it's been fairly flat, 5-6% growth only. Yeah. Where do you see the direct equity markets versus mutual funds?
So both complement each other. Logically, if one sees, then direct equity, suffers from some problems, which is that there are many avenues which will tell you what to buy, will not tell you what to sell and when to sell. So what typically happens is you keep accumulating stocks that you hear your ecosystem suggest to you, but you don't get out of them, and the end results are not nice. What a professional manager does for you is to keep it tight, getting in but at the same time getting out of stuff that need not be there. Right. is part of the service. So I would believe that for most investors doing it themselves versus through funds would have a better outcome. Now here most investors don't feel so.
Right.
Okay, and this is because they don't compare likes to likes. They invest over a period of time, and that result they compare with a mutual fund investment of theirs, which they may have done at a point in time. Okay, so at a point in time, for example, if somebody did it December of last year to now would be zero. But then if you have invested on your own over Jan, Feb, March, you would be sitting on 15 to 20% returns. So this is the problem. But like to like, if one sees, for most investors, mutual funds should end up doing a better job.
Okay. So at Motilal Oswal, you have this formula called QGPL, quality, growth, longevity.
Longevity and price. Yeah.
Price, yeah. So can you just expand that for me? How do you do this in the context of a retail investor giving you a portfolio?
Sure. So we are growth investors. A growth investor seeks to make money from sustained growth in earnings of a company.
Right.
Okay. Now, if I tell you one company does 40, 40, 40, 40, and the other company does 12, 12, 12, 12, you will obviously say the first one is better. Okay, second one, by the way, is very close to index. Okay, so quantum is important. I'm just trying to establish that quantum is important. Right. In the same example, if I have another company which instead of doing 40, 40, 40, 40, does 200 in the first instance and then does nothing for next 3 years, which one will you then choose?
Right.
Okay, now the thing is most people will still choose the first one, because in the second one, after first great growth, you are not getting much. Okay, and this is the key difference. Quantum is important, but longevity is super important.
Right.
In a traditional valuation methodology, if you employ a DCF, the second one would have a better outcome, most probably. Okay, because the big one is happening instantaneously. But in terms of what most people will end up holding is the first one. Now, what QGLP does is to start with a focus on longevity. What we do is to flesh out narrow themes in our group.
Right.
The managers do it. And then as a part of the process, we encourage each manager to have as many themes as possible represented in the fund. And once you do it, the construct automatically becomes one of the highest growth in earnings constructs in the cohort. That is what it is. Now, of course, so we spoke of L. and then it is the quantum, which is what the manager does, and of course looking at valuations. So sustained growth in earnings. Sustained growth is important.
Right.
The better is the quality of a business, the more of that growth can be had internally versus going to external sources for funding.
Right.
So, the better the quality of the business, the more sustainable, de-risked you call that growth to be, versus if you are a, let's say 15% ROCE business and there's a market opportunity of 30%, it basically means you have to go to the market to raise money.
Okay.
It is possible, but riskier than if you had a 30% ROCE and your opportunity is 30%, you can fund it internally.
Okay. Right. So you've had a long stint with SBI Capital Markets and then BNP Paribas, all of that, and probably close to 30 years now. You've seen this entire industry grow. So in your experience, how have you seen this market shift? The investor interest in equity markets, where it was, say, a decade ago and where it is now. Is it because the markets are at a high and this is probably the only avenue where people are making high returns or were making high returns? Right now it's a little flat compared to any other savings instruments for retail investors.
Sure. So if I go back to early 90s, the bank deposits used to give good, nice double-digit return.
Right. Yeah.
Okay, and risk-free. So for most people, the outcome by putting money into a bank deposit and maybe a tax-free instrument like a PPF worked better than equities. As time progressed, yields fell. So now in a bank deposit, max that you get is 7 to 8%, depending on age, etc., etc. So that reduces the hurdle for equities. So that is one. And now you see more people saying, this is not sufficient for me. Let's just try out a more volatile, riskier thing, but maybe better outcomes. So equity.
Yeah.
The second thing that has happened is back then the per capitas were lower, and people can associate it with earlier you used to get all of the investors from 4 metros, and then the richer parts of the country, let's say Tamil Nadu, Maharashtra, Gujarat, is where the equity investor base resided. These were the richer areas. Now, as the wealth is percolating down into the hinterlands, more and more people, and I keep saying this, for the same reason that somebody is buying an AC, he has more money, is the reason that he is coming to the equity market. He has satisfied his basic needs of roti, kapda, makan, children education, marriage, etc. Now, there is this money that he can take a risk on to improve his overall trajectory, and he is coming to the equity market.
Okay.
So as you see the per capita in the country expand, you will see, at least this is what I believe, you will see the equity cult getting stronger and stronger. See, we are somewhere in between China and the US, right? In terms of our thinking and all of that. Look at the Chinese example. They were recipients of FDI, FPI in 2008 when Lehman happened. Today, look at them. They may be the largest globally in terms of putting money out. Whatever number of years we may be behind them, we are starting to see the same stuff happen to us.
So we're maybe about 20 years behind China.
So yeah, we are starting to see surpluses getting invested into the markets.
So what role does technology really play here now? There are two questions in this. One is, of course, with easy access to smartphones and better internet connectivity, all of that, people are more clued in and can keep track of their portfolios in real time. So those who want to invest directly in the market can do so through various apps. Those who want to invest through mutual funds can also track it on their phone real time, keep moving portfolios around. And at the same time, we are now at a cusp of newer phenomena coming in like AI, which could probably, and I don't know, this is an opinion I want from you, would it be a threat to fund managers or not? Or would AI be your friend in terms of predictive analytics in the markets especially?
Yeah. No, so people are using data for sure. Knowledge is now on fingertips.
Yeah.
And one manifestation of that you see is that increasingly the digital channels are taking precedence over legacy, brick and mortar channels, and we believe could continue to do so deep into the future. So there is a value addition that an intermediary has to do. If the client thinks that he is not adding that value, we will go direct through digital means. So that is something that is clearly happening. Now, more of digital also means that our ability to reach a lot of people is possible versus earlier. Through Zooms, through podcasts like this one, and so on, to share how are we different from others. Not everything which invests into stocks, and results in a portfolio is meant to achieve the same objective.
Right.
Objectives differ.
Yeah.
So to be able to communicate as to what we stand for, why should people look at us? We stand for growth. People should look at us for growth in earnings, and come to us if they believe, for example, markets follow earnings growth. It's stuff that you can do on a digital platform much more easier versus the traditional brick and mortar. So that is clearly happening, will continue to gain in strength, especially as more and more younger people come into the investing this thing. For us, for example, we may be having 2.5% AUM market share, but we have 17% client market share, investor market share.
Okay.
Now, and this is mostly digital. Coming down to your next one, which is whether AI is a help or whether it will disrupt traditional fund management. See, AI to crawl, the engine to crawl, needs data which is arranged in a particular manner.
Yeah.
For most active managers, that data does not exist.
Okay.
So for AI to be able to mimic and do a better outcome versus a manager is very difficult, point one. Point two, if a manager slots himself into a particular kind of investing, already the world has factors, so volatility, value, momentum are factors. So if a manager is seen to be close to a factor, then AI can come and almost predict what he or she may do next.
Right.
And can be both a help and a hindrance, and a competition. So I would say that AI can be used, can be harnessed initially, at least in the quant kind of strategies, where any which ways the data are available, the guy who is doing it today is arranging it, and he will be able to harness an AI to help him out. So it's a win-win. For AI to disrupt the traditional active management system is going to take a lot of time for this reason. Data is not available. And secondly, AI can study one person's. So in a given situation, let's say a person is looking at a large cap fund. 80% has to be, this is the easiest part of as you go flexi and small, the numbers increase and it gets more and more difficult. But 80% has to be top 100. Now what is the top 100? Where has he put his money? What percentage is? Will give you the stance of the guy, his growth, his value, his what.
Right.
Every change that he is doing, AI can study. 10 changes, there is a pattern that forms. And you try and, just like in chess, you look at it, you start to predict. So much is the possibilities, what is the guy choosing? So you can get around, but it is that difficult. Now, instead of one person, if that person is seconded by a team of people who suggest and the guy is implementing, so he is not the actual decision maker, he is getting influenced, AI will find it that much more difficult.
Okay.
And then in India, what also happens is, if you look at it, managers change. AI would need data points to look at a guy. If the guy moves from platform 1 to platform 2, that chain breaks. So it's not going to be easy for AI. We will make it quite tough for it. Don't worry. we want to be around.
True, but I mean, it could also help you in terms of working on your own data and making faster decisions.
Like I said, quant, very clearly, yes. For research, it is definitely helping already.
Right.
Yeah.
Okay. Now, beyond mutual funds, you also have other instruments. Which do you see in the next 4-5 years being the biggest assets for your growth?
So we do believe mutual funds would be the fastest growing asset class. It is a very investor friendly asset class.
Yeah.
For us, we have been saying we do what we do best across. So be it mutual funds, be it alternates, everywhere you see growth investing, everywhere you see focused high conviction portfolios. So we say we do what we do best for everybody. There are things that mutual fund as a vehicle, for example, is not able to do, not permitted to do. And in periods, those things can result in substantially better outcomes. So, for example, investing into unlisted names, whereas an AIF kind of a vehicle, Cat 3, can go up to 50%, 49%. So, I think alternates will have to more and more try and do stuff that mutual funds are restricted from doing, and do a very good job at that to make themselves be relevant to investors. Yes, alternates have an advantage of crafting very, very sharp portfolios. They are not encumbered by much. Regulation is light touch and all of that. But they also suffer from a tax disadvantage.
Right.
But that said, if I price it on, once an investor has taken enough exposure to a mutual fund and is graduating in size, maybe a lot of the alternates would also start to get relevant to him, especially if an alternate is doing something which a mutual fund can't do.
Okay.
So that is where I think the realm of alternates would be. Now, which part will grow faster? Well, thing is, our environment keeps getting changed, but suppose we assume the rules as they are stay constant for 5 to 10 years, and one believes the top income bracket of the country grows fastest.
Yeah.
So it grows fastest. It's the top income bracket which is the client for alternates.
Right.
Given that, you would expect alternates to do pretty good growth. But what we have seen happen is, over a period of time, the entry keeps getting stiffer. So from a 5 lakh, for a PMS became 25, then became 50. So as a big chunk of the industry is taken away,
right,
growth does get impacted. But ceteris paribus, alternates have a very good chance of growing as well.
That's why I wanted to ask you about your portfolio managed services. I think that's a fairly large part of what you do.
Yes.
How do you approach that compared to a regular mutual fund investing strategy?
No, so like I say, we do what we do best across. It's growth investing across. It's just that
what
on
is the
the
differentiating
alternate
factor
side,
that you bring?
on the alternate side, it can be more sharper in construction. And we have this unique product where we mix listed with unlisted. This is something that you can't do on a mutual fund.
Yeah.
So we have already done 3 series of such products. 2 more are in the works. And the outcomes with investors has been significantly better. So that is the way forward to our mind. Yeah.
So what are the themes or sectors that you look at with these funds?
No, so see, we are growth investors. Let me do some small maths for you so that people understand why we are where we are. index for a long while has done between 10 to 12% earnings growth. De facto, the math is you do 6% real GDP growth, inflation 4% this year is lower, and on top of it, some margin changes, plus move away from agriculture into industry and services, the other two parts which are there in the market. You get to a range of 10 to 12%. Now, if we seek to make most of our monies from growth, then if we have to do a good job for our investors versus this 12%, add 3 to 4%, 16 plus fees, 2%, 18 plus errors, omissions, we budget for 2 in a year. So, the lower they are, the better. You get to around 20. Okay, now if we look at the index, I gave you that 40 example. The number is 20. Which part of the index you think will do 20 for a few years?
Right.
Okay, if you struggle to find any, is the reason why you will struggle to find much of index in our constructs.
Okay.
Now, which are the parts which will do that? So, if you are talking long term, and many of these spaces that I will talk about are young spaces. So, for example, in healthcare, will hospitals do it? Will GLP-1 beneficiaries do it? Travel, tourism, new tech, these spaces, new tech wasn't there 7-8 years back. Electronic manufacturing, renewables.
Right.
And you get the drift capital market. So there was no mutual fund listed 5 years back, for example. Luxury, jewelers, for example, hotels, for example, premium builders. So, very, very narrow niches, electric vehicles, which will, to our mind, do what we want. So, in our constructs, you don't find much index across the house.
Right.
And you find a lot of these spaces that we spoke about being there. So, if there is anything from the index which is there in the construct, it is because, we may have got it first, and because of growth, etc., it went into the index. We do money management the old-fashioned way, like people used to do in early 2000s. Get in something where you think there is an upside, and not do something because you hug the index. So we say we run funds, hence I explained to you why. Because we believe market ultimately follows earnings growth. That is the method in madness. So we run funds of over 90% tracking error. One should deem it to be very risky. But we have to make risk pay for the client. Okay, and we do it by building high earnings growth focused portfolios, which we believe has the best combo of valuation as well, to just increase the chances of our clients, our investors ending up with a very good outcome. And we communicate, this is what we do. So yes, high growth in earning strategies would be high beta by definition. But if you are a long period investor, over time market moves up, higher beta, good high beta, not leverage beta, not commodity beta, high growth in earnings related beta should result in better outcomes. So this is basically what we do.
Okay. In the beginning, you mentioned moving beyond the bigger cities into smaller markets where people are now getting aware of AMCs and being able to invest in this. What are you doing in that area to kind of build trust, one, with the investor from the smaller city?
No, so in our business, you say trust, I say credibility, one and the same stuff. Is very important, big city or small city. And towards it, if you look at my communications over 3 years, it is very consistent. Okay, trying to explain why we are doing what we are doing, just like I did it now.
Exactly.
First time I did it was in May 23 video.
Yeah.
Okay, fleshed out everything. And if you see the construct of our portfolios of the house has been doing it for a very long period of time. So if somebody is doing what he is talking, the whole house is doing what they are talking, I think over time it results in credibility is getting built and restored.
Right.
That is something that is really happening. Second, of course, is getting the voice heard. So that can happen through two ways. Earlier we were very, very large city-centric organization. Now we are present in 70 locations. So when you have teams in 70 locations, the number of people who get to hear you, your views, etc., increase is one. Second, digital. So we have this program where, for example, I do 2 calls to direct investors a month plus 1 to distributors. So 3, my managers do 1 on the mutual fund side, 1 on the alternate side.
Yeah.
So 5 calls a month where anybody can log in and hear the views are done. So overall, I would say between these 5-6 calls, we would be covering quite a few thousand investors every month.
Okay.
We try and see we cater to different set of people in different periods, but many are overlapping. So this is something that we do. And in our whole thought, there are people who are thought leaders. They do something, they talk about it, and 10 other people get to know you, hopefully for the right reason. And what we have also done is to have a pool of over 200 people who engage with the clients, trying to tell them what we do, why they should look at us. We think the outcomes are in terms of pitching, in terms of communicating our thought process way better than what any third party can do.
Right. Okay. I have a couple of more questions for you before I let you go. And this is more on a macro level. You are seeing in the last couple of years, everybody is going IPO because the markets are at a stage where it's ripe for picking. There's so many new IPOs in the market, startups, new sectors coming in, trying to raise funds. We've seen some of them list at a high price and then go south. So there's a lot of wariness also with this IPO market. For a first-time investor getting into the market now, and let me break it up between the 20 to 30 age group and then the 30+ age group. What are the kind of investment strategies they should be looking at? A 20 to 30 and a 30+.
No, so it is basically doing it yourself or giving it to a professional. Now, if somebody is in an industry, okay, he or she will know hopefully more about that industry versus somebody who is outside that, right? So I keep saying you increase your chances for success if you are with where your knowledge lies. It could be your alone, it could be a set of friends you may have, and each other, you hold each other's hand and do a bit more. But if you want to go outside your realm of expertise, the outcomes will start to diminish. So be disciplined, whether you are young or old, to improve outcomes.
Okay.
The only thing that a manager brings, one of the biggest things that a manager brings to the table is discipline. What not to look at, because there is something, like you say, that keeps happening every day. 6,000 stocks, prices move up and down. There is a cacophony out there. What to do, what not to do. Discipline improves the outcomes in a sustainable manner quite a bit. So write it down. Why are you investing? How would, everybody understands stock represents a business. Business, what should make the value move up? Maybe the business is in stress today, value investing. Maybe because of some reason the stress will go away. Write it down. And hence you are choosing this business. Maybe, for us growth investors, these are spaces where growth will be there for
Right.
longer. Best positioned companies. Writing it down increases the discipline. Anything that increases discipline, you should do.
Okay.
The outcomes will improve.
Perfect. Now, last question is on the Indian market as such, and how resilient is it vis-a-vis global forces? I mean, you have US doing a lot of tariff negotiations, which is impacting global business, but India has been fairly resilient that way. Despite the changes in the US market, despite the change in the oil market, despite global conflict in various countries, we have in the last couple of years been fairly resilient. Where do you see India standing in the long term, say 5 years?
Yeah, so think of it, if you were a year back, and you thought that in the budget there will be a tax cut, repo will be cut by 1%, GST cut would happen, earnings would move up by 8%, and the world would be celebrating. One would have thought we would have done much better. We haven't.
Yeah.
We are flat. So if one follows market follows earnings growth kind of stuff, then I liken it to a spring that is getting built, spring energy getting built. A few things happen, and that release of energy can happen. So one thing that you pointed out is trade deals.
Yeah.
So quite a few countries have got it, and if you see the performance of their market before and after the deal, it's very different. They've been celebrating. We haven't got one, which is why probably we are where we are. One reason, but if we are where we are, then we should believe that it is in the price. So unless worse happens, now on, it should move along with earnings. One. Second is we have been, so if you liken the market to demand and supply of paper.
Yeah.
So if PIs have been selling, you should assume they continue to sell. Domestics have been buying. One should assume that as per capita has increased, they buy more. And there is supply of paper. Now this year versus last year whole, I think we did 3 lakh crores of fundraise from the market. This year by October we have done close to 6. So when the new paper flow is a torrent, typically the markets would be sideways, and this may actually be a bigger reason than the trade deal not happening. Now the good news is that last few IPOs have done well.
Okay,
and especially the larger ones. So numbers will come, but when this thing happened, if you go back to our times, Maruti happened in 2002.
Yes.
Yeah. Every IPO sucks in newer investors. If those investors get a good taste, markets change direction, sentiments change. I think something to that effect has happened in October. The biggest IPOs are behind, so every month now, while stiff, but doesn't have October kind of fundraise. And people who came in October, most of the issues did well, the larger ones did well. So I think the positive rub-off on the market should be there going forward.
Okay.
So as we speak, I am pretty hopeful things would be nicer. Difficult days are probably behind. Better days are ahead is the thought, except that Jan-Feb volatility that one encounters very regularly. Now, even on the trade deal, if we think that US is the largest buyer for a lot of what we do, and we could be the largest buyer for a lot of what our US may have to sell.
Yeah.
Read energy, read food, read defense. I think we will get a deal that, if your biggest buyer is going in front of you, how will you treat it? So we are both, or we can be both biggest for each other.
Okay.
So I think if the treatments are in line with the size of the economy, ability to buy, and growth, because wherever you start today, every other country, European country, and a lot of the Asian countries may be growing slower than US, we would be growing faster. So whichever level you start with, over time, US will export more.
Right.
The trade balances will change. So I think our negotiators know that, their negotiators know that also. Do believe the outcomes will be good. And if the outcomes are good, that reason will also go away. So now that everything has happened, time to be very positive.
Okay. So on that positive note, I would like to thank you so much for joining me on this podcast.
Thank you.
And let's hope for the best. Thank you, Prateek. Thank you so much. For more such news, keep following financialexpress.com. Thank you.